Global commodity trading operates at a massive scale and a punishing speed. Millions of tons of raw materials are constantly in motion, where the difference between a profitable trade and a loss is calculated in pennies. To navigate that system, traders rely on daily intelligence artifacts. This is the August 24th, 2026 pricing sheet from Polymer Bazaar. The data arrives unformatted, packing different global currencies, weight measurements, and regional shipping acronyms into a single, dense text block. Polymer Bazaar's core philosophy is built into the data itself: price, prediction, and profit. By standardizing these metrics, we can identify the specific arbitrage windows and shipping bottlenecks that dictate daily profitability. This data functions as a map of global supply and demand, tracking the geopolitical pressure points of the market for a single day. Mastering these raw numbers allows a trader to stop reacting to market shifts after they happen and start anticipating them before the competition. At the top of the sheet, we find the naphtha entry for Japan. Naphtha is the primary upstream chemical feedstock that dictates the economic floor of the entire Asian petrochemical market. The entry lists a specific Incoterm, C&F, or cost and freight. This indicates that the $830 price tag includes both the base cost of the chemical and the cost of ocean freight to a Japanese port. The +5 indicator next to that price establishes an immediate upward baseline pressure for the region. This localized $835 baseline determines the economic viability of all subsequent chemical cracking and manufacturing in Japan for that period. While global averages provide a general trend, localized, term-specific data shows the actual cost of putting material on the ground. Accurately decoding this baseline sets the absolute floor price for every downstream trade and negotiation in the Asian market. Moving down the sheet, we hit the olefin categories: propylene and ethylene. Looking at the propylene data for the United States, the U.S. trading unit is listed in cents per pound, and the delivery terms are FDGC, free delivered to the Gulf Coast. Now compare that to the European propylene data. The unit changes to euros per metric ton. The delivery terms are split between CIF and FD Northwest Europe. Finally, look at the Asian propylene data. Here we find a third unit, US dollars per metric ton. European prices are dropping, down 5 and 20, while Asian prices are rising by 10. The scale of this divergence is difficult to see because the currencies and weights don't match. When we normalize these numbers into a universal metric, US dollars per metric ton, the market reality becomes clear. On a standardized scale, the European price is dropping significantly lower than the other regions. At the same time, the Asian bar is rising, creating a widening gap between the two markets. This gap represents the margin between the low European price and the high Asian price. This is an actionable arbitrage window. The specific spread where buying European surplus and shipping it to Asia becomes profitable. True supply chain visibility is the capability to instantly normalize fragmented numbers to identify these global opportunities. The final block of the intelligence sheet covers aromatics and derivatives, styrene, PTA, and MEG. We can trace the causal link from the upstream olefin gains in Asia directly into the downstream $15 gains for Asian styrene. But consider the PTA data for the Asian market. The entry is marked NC, or no change. While upstream raw materials are getting more expensive, the downstream PTA price remains flat at $920. This rigidity suggests that consumer demand for downstream polymers, like PET plastics, is too weak to absorb those upstream price hikes. Because manufacturers cannot pass costs to the consumer, they must absorb the difference, which leads to severe margin compression. Identifying stagnant markers like NC allows traders to foresee these bottlenecks before the physical market reacts. Standardizing Incoterms, currency conversions, and downstream rigidities across global markets requires constant calculation. Manually calculating spreads like FD Gulf Coast against CIF Northwest Europe is too slow for a volatile market. Arbitrage windows often close in a matter of hours as the market self-corrects. To maintain a lead, traders utilize prompt-driven AI integration. Using the Polymer Bazaar AI WhatsApp chatbot, a trader types the prompt Feedstock to instantly receive a normalized analysis of the global spread. This data retrieval takes less than 5 seconds. Eliminating calculation latency shifts a trader from a reactive posture to a proactive one. This speed supports the 3 pillars of the platform. Instant data parsing secures the price. Normalized global visibility enables the prediction, and zero-latency execution captures the profit. In the modern petrochemical supply chain, data velocity is the ultimate competitive advantage. The margin belongs to whoever can decode the spread first.